Here's how you can buy 10 rental property within 5 years by using the Burr strategy. So the first thing I want to talk about is this. We always got to start with the end in mind and then work backward to the present. And then we have a game plan that we can actually move forward. So with the
That makes total sense. Any investment, any strategy, really anything we're doing in life, we're going to want to start at the end of the mind and work backwards. So that makes sense. Who doesn't want to buy 10 properties in 5 years, right? It makes sense. But what is this Burr? What does Burr mean? It's Burr. Is it cold? I don't know. I'm excited to learn this video of how I can get 10 properties in 5 years.
end in mind, here's what the question I want to ask you. 3 questions, okay? First question is this. At what age do you want to have the option to work or not work? When my mentor started mentoring me, I was like 26, 27. And he asked me that same question. That's at what age do you want to have the option to work or not work? And I said, well, if I got to about 45 years old, if I have the option to work or not work, that's when I really feel that I can retire, okay? He said, great. Then the second question that he asked me was this. How much passive income would you like to have every single month to live comfortably if you're debt-free? Especially at 45 years old. And I said to myself, you know what? If I had like, you know, maybe $15,000 a month in passive income and I'm debt-free by the time I'm 45, I think I can live real good. You know what I mean? Debt-free, you know, $15,000 a month. And then if I want to work on top of that, I can. Man, that won't suck. So he was like, okay, great, 15,000. Then he asked me, what is the average rent? And at that time, I think rent was about 1,500 bucks. And so I needed basically 10 rental property bought and paid off by the time I'm 45 years old, so I could actually get $15,000 a month. And so I was like, okay, so I got real clear, right? I want to actually.
So the 3 questions are really, really good, right? You're thinking about, yeah, what age do I want to retire? What income do I need? And how many property? What's the average rent on those properties? All of this makes a lot of sense, right? As we know, real estate goes up. There's only been a 3-year period of time that rents have actually gone down. If you go back to as long as they've been tracking data, since 1900s, if you went back there, you'd see that rents have only gone down in a 3-year period of time. Over time, rents typically go up. So everything he said so far makes a tremendous amount of sense.
Work or not work at 45. I want to have $15,000 a month in passive income by that time, and average rent $1,500 per unit. I need 10 of those. And then my why was, by the time I'm 45, I want to spend the second half of my life actually enjoying myself, traveling with my family, my kids. I didn't have kids back then, but I was thinking of all that. And I want to make sure that I set myself up early, so by the time I'm 45, I have the freedom to work and not work, have money coming in. If I want to work, I can make more money on top of that, and I can spend time with my family, do the thing I really want to do if I didn't have to work. So that was my why, that was my game plan. So then basically at 25, 26 in that zone, I was focused on started accumulating 10 property. So let's talk about phase 1.
So before we jump into phase 1, which I'm super jacked to see, there's a little bit of a disconnect, and this is how things are shown online, right? We noticed we saw like a Ferrari, I think that might have been a Rolls-Royce, in front of a really great house. It looked like San Francisco almost. $15,000 a month is not going to land you the Rolls-Royce Ferrari lifestyle. It's just not going to happen. So there's a total disconnect in a lot of these videos between reality and the passive income, and then the reality of what will actually buy you in real life. But let's see what phase 1 holds.
Which is accumulation. The first thing we're gonna do, we're gonna accumulate. We're not gonna worry about paying them off anything. We wanna accumulate the 10 door first, okay? So in order to accumulate 10 door, there's 2 things we gotta look at. 1 is the money to buy the property, and 2, you gotta have basically good credit and good, you know, income, low debt, so you can.
Spoiler alert, to buy real estate, yes, you need money and credit. You also need market analysis, a strategy. You need to understand rent. You need to understand your expense ratios and all the different things that go to manage rental properties. What's your strategy? Is it condos, single family? What market? Are you going to the Midwest where cash flow is higher? Or are you going to do some appreciation, try to get both? Or you go to the West Coast like San Diego where you have less cash flow but more appreciation? There's a lot more that goes into actually making sure that investments, that single family, or there's a lot more that goes into making sure real estate investments work for you.
Qualified to actually buy the property and keep it as rental property. So let's talk about credit first. If you're gonna actually buy something whole, if you want the best rate, you gotta get at least 720 and higher on your credit score. You gotta have good income, okay? And then of course, you wanna keep your debt down low. Now, the second is talking about income. If you make good money already, you can buy one and then buy another one. For some of you guys are a little bit tight on money, right? If you got one job and you're making good money, great. But if you need to make more money, you gotta start thinking outside the box. Where can I actually make more money? Where can I actually create more money so I can have more money come to the front door so I can actually buy more property? I want you to start thinking about that. You got one income from your regular job, and then start figuring out how to increase your income by adding, one or two or three other sources of income so you can actually make more money, because the more money you can make, the faster you can buy your 10 property. All right, so
creating multiple streams of income is a really good idea. Most wealthy people you see have about 7 income streams. So everything he said so far, I totally agree with, and I'm actually kind of excited to see what happens.
Let's talk about accumulating. Let's say you don't own a house at all right now. If you don't own a house, you can buy your first house as a first-time home buyer with something as low as 3.5% to 5% down. If you did that, you bought your first property, then you live in it, and then if you want, maybe rent out a couple of rooms or rent out the basement, right, to offset your mortgage so you can live there for little to nothing, or, free. Now, you live there for a while, let's say a year later, you decided, you know what, you got enough money, you want to buy another one. Turn that into a rental.
So what he's talking about here, we're going to buy the first house with FHA financing, which is 3.5% down, or 5% down, which would be conventional financing. And he's using a thing that's popularized on Bigger Pockets called house hacking. So you buy a 4-bedroom home. Let's say you've got a mortgage of $2,000 per month. You rent out 3 of the bedrooms for $700 each, and voila, you're not paying anything. You're actually getting paid $100 to live in a home, and you've got to pay, or you're paying, say, $500 to cover all the utilities that'll be involved in that home. Not terrible. And then you could take that, you could move out and then rent that property out. Now, the challenge, what we're not showing here, is typically when you put very little down, the mortgage is higher than market rents. What makes properties work is buying beneath the market value, so getting a discount when you buy it, and then putting a significant amount of money down. It's the capital you put down that actually creates the monthly cash flow. The discount to market and the money you put down. So if we didn't put a lot of money down, I'm curious to see how that actually makes the property cash flow if we get into this in this video.
And then go buy the next house, and then you do that again. So let's say after your second or third time you did that, 5% down, 5%, and you don't want to move no more. Now, since you're not moving no more, you gotta start buying property where it's an investment property. Most banks don't want at least 20 to 25% down. Now you start to accumulate the next property, until you get to 10. When you get to 10 property, then I want you to stop, and we're gonna start talking about how to pay them off next. All right, so now
we own 10. We kind of skipped through some of that. We're missing some key components. We kind of went 1, 2, 3, bam, 10, right? I think there's a few ins and outs that might occur in those two parts. Yes, banks do want 20 to 25% down. Why do they want that? Because they want to show that you have skin in the game. Typically, when you buy a property for investment purposes, what wasn't mentioned in the video is those rates will be higher. So when you're buying as an owner-occupant, banks know that if you're gonna not pay anything, typically you're always gonna pay your mortgage. So they give lower rates to people that own the homes and live in them, as opposed to investors who buy the homes and don't live in them. So there's a few things that might occur there differently in reality, especially the first 3 properties that he bought in this scenario. All will likely have negative cash flow, meaning that he's gonna pay extra money every single month for a very long period of time before it'll actually make sense.
already completed your accumulation phase. Now you're at that point where you got 10 doors, and based on your 10 doors, you have a certain amount of gross rent. Let's say you want to go for $25,000 a month in passive income. So each basically unit is worth $2,500 in rent.
Wow, so excited. We went from phase 1 and we just skipped ahead in our time machine. We were getting $15,000 a month. Now we're getting $25,000 a month. I don't really know how we went from $1,500 a month in rent per door to $2,500. Because rents typically go up on average. My target is I push 5%, but it's really about 3% per year on a normal year. What you could sustain over time would be the rent would go up 3% every single year. I mean, if you want to run the math, and we could do it, we'll put it somewhere, a link in the comments we'll run the math on how long it takes at a 3% increase for rents to go from $1,500 to $2,500. I'm guessing on the top of my head, that might be a 15, 20 year period of time that we just kind of jumped over there real quick in about 12 seconds in the video.
rent and you got 10 doors, you got $25,000 in gross rent. Now, until these things are all paid off, that's when you're gonna get all $25,000 a month in passive income for life. Now let's talk about phase two, what we call the payoff state. There's a
Gosh, I'm excited for phase two. And what's the cool part about phase two, if the dreams are big enough, the facts really don't matter. I'll let that think in there. I'll let you think about that for a minute. If the dreams are big enough, the facts don't matter. That should be the Instagram influencer's tagline for most folks, because the reality is the facts do matter.
A lot of different opinion about paying off property out here. Because everybody always talking about leverage, 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 leverage. Don't pay off your property because you can always leverage. But this is what I'm gonna say. It all depends on this. It depends on how old you are. It depends on how much income you bring in through the front door. And it'll also depend on what your experience you want to have in your life. All that matters, okay? So let's just say, for example, let's start with age. Let's say you're 53-year-old like me, okay? And you know what? You don't want to keep working forever. You want to actually have enough passive income, so if you want to work, you can. But if you're 53 and you still are leveraging and buying more property, and each one of these properties only making $500, you're never going to get the full effect. But yes, you might say that, yeah, but I got 100 properties, so those 100 is giving me $25 a month. Yes, great, but you don't have peace of mind because you still got 50, 60, 70, 80, 100 million with the loan outstanding, and you're 50, 60, 70 years old, still out there grinding, running on a treadmill, trying to pay the mortgage off. At some point, you want a peace of mind. That's why people in this real estate game, peace of mind is underrated. They don't think about that. And what kind of experience do you want? Do you want to actually have a very freestyle experience when you're in the 50s and 60s? That's the best part of your life.
I got to be honest, I want that freestyle experience, that sweet, sweet freestyle. Now I've got the cars and I was able to pause at the right moment. That is a McLaren. And then that is the, I think that's the Rolls-Royce Phantom. So $15,000 a month is not really going to make that work. You do want peace of mind, but the properties that you reference are not going to cash flow $400 or $500 that you bought with very small down payments. That's absolutely not going to happen. The other challenge of a small down payment is you also have what's called PMI, or private mortgage insurance. And so that's basically a tax or something banks charge because there's higher risk. You might actually default. You do not have PMI on when you put 20% down or more. And so that's another factor that's not being considered. A long time ago, the PMI would go away once you had 20% equity in the property. Today, the PMI stays indefinitely, and that could be several $100s a month, and just a fee you're paying as a part of your payment that doesn't go towards your principal payment, doesn't go anywhere. It's just because you didn't put money down.
But you want to spend the time relaxing, going out, do things, versus worrying about kind of keep grinding. So let me go ahead and start off by addressing the young adults. For all the hungry lions out there that want to say, Thatch, I want to buy more than 10 properties. I don't want to stop. I'm making good money through the front door.
What does he say to the young hip kids? What does he say? I'm jacked to see it.
Two things you can do, okay? One is, since you got your 10 now, and you're still young, and you got good money coming in, let's keep buying more. Let's buy 11, let's buy 12, 13, 14.
Smart, get the negative cash flow, make it up in volume, really get the machine cranking. Lose 500 a month, what if you get 100 of them? You know, could you lose 50,000 a month? Maybe, it's all possible.
Let's say you buy 20 or more, now you have 20 property or 25 property, okay? Now you're up there, and you only need 10 to really live a good life. So let's say you got 20, 25 property, you know, and you're in your basically your 40s now. So now you feel like, you know what, I think I'm good. Now what we can do, we can sell probably half of those property, take all the equity out of those properties, since they have all rise in appreciation, take half of the property, sell them, and take all the cash, and then dump it off on 10, 11, 12 property you have. Now you have all of them free and clear. Basically now, you didn't have to pay extra money to pay it. You just took all the equity you had from property number 11 through 20, 25, whatever it is that you decide to keep growing. Take all the equity you made from the appreciation of these property, then pay off your 10, 11, 12 property. And that's another way to actually do it without stopping at number 10. All right, now I want to address.
Not a complicated idea. Anytime you sell something, if you make money and you have dollars in your account, you could spend that money paying down debt, investing it, buying a cheeseburger, or getting that really cool motorcycle you showed in the video. Any of those things are possible. Of course, when you sell something, you could pay something down. And selling real estate and paying down what you own is not a terrible strategy, depending on the interest rates that you have on the properties, the interest rates of today. And lastly, you'd want to look at kind of the 10-year treasury rates to kind of determine what makes sense. The reason you always want to look at that is that's your risk-free rate of return. In other words, you could put money in the 10-year treasury backed by the federal government. So if I can get, as if we're filming this right now, it wouldn't make sense to pay off a 3% interest rate on a property if you can make 5% on a treasury bill or 4% on a treasury bill. It would not make sense.
The older folks right now that doesn't want to buy no more property, they got to 10, they go, Thatch, I don't want to buy no more property. I'm good. I just want to pay them off. So this is how you go about paying off your property. So what you do, you take the 10th property and you take the lowest mortgage first. And that's probably the one you bought first, typically. You take the lowest mortgage one first, and then you're going to start actually making payment towards this property. You're going to put extra payment towards this property. You can take your earned income, any positive cash flow you get from all the other 9 units, you keep dumping it down on the first property. We call this a snowball effect. You keep dumping it. Then when this is paid off, then you repeat the process. You do it to property number 2. And then when that gets done, then you actually do it to property number 3, and then so on until all the properties paid off. If you do this right, folks, you can get this thing put out very rapidly because the snowball effect, it gets bigger and bigger and bigger as you go towards number 5, going towards number 10. So here's a bonus.
This is the best part of this entire video. Go back and watch that. The concept of taking your extra cash flow and aiming it at your lowest balance, taking your extra income and putting on there, and then using, once that's paid off, using that additional cash flow to pay down debts is a very, 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 very smart strategy. It's using velocity of money. How quickly can I get things moving? And you're reducing it. I love this idea.
Bonus tip for you about monthly payment. How much interest you save when you actually make extra payment. Check it out. Let's say you have a mortgage of $300,000. Let's say you have an interest rate of 6% on a 30-year fix. Your monthly payment principal and interest is about $1,800.
Here's the problem. If you are watching this video and you can show me any house in the country, anywhere, reach out to me directly that you can buy for $300,000, or let's say he's buying for $310,000 because he's putting 3.5% down, or $315,000, that will cash flow positively $400 per month, it'll never happen because you got an $1,800 payment that's principal and interest. In most markets, taxes and insurance are going to run, let's call it another $300 for tax and insurance combined. You have $2,100 per month. Your average rental, your expense ratio, the total amount of expenses, vacancy, repairs, taxes, insurance, management fee, HOA, all of that you want to average 35% or less on a property, not including the mortgage, but just the expenses. So you would need to rent this house for $2,500, maybe $2,800 a month in order to be able to cash flow at all. So right now we're kind of blowing up the model here, right? Because rates today for investors are around 7.5 on the investment side, which even makes the math work. So the challenge in his math is it doesn't work on your first property. You're losing several $100s a month every single month. So as you go to get future loans, when you're losing money, it makes it harder to get every one in the future.
Okay? If you make one extra payment every year, at the end of the year, you make one extra payment, and you write it principal only toward your payments. So you have 12 regular payments, and at the end, you make one extra payment, principal only, you turn that in, you will shave almost 6 years of your 30-year loan, and you will save about $76,400 in interest.
This is absolutely right. If you make one extra principal payment per year, the math's between 6 and 7 years you would save. However, you've got to realize in his scenario, you've already lost about $5 or $6 grand that year. So now you're adding another $1,800. So you're losing somewhere in the range of $7,000 to $10,000 per property. So when you get 10 of these, you're losing $7,000 to $10,000 a month, not the 15. Then if you could just close your eyes and hold your breath, if you could wait 30 years, yes, they will be free and clear. You just have to stomach the $7,000 to $10,000 for the 30 years.
Make one extra payment. If you do it every quarter, right, principal only, that's 4 extra check at the end, every quarter, okay, at the end of the year, okay, you will save about $176,000 worth of interest, and you're gonna shave off 13.8 years.
Now we're getting to where we're paying 4 extra payments per year. What if you paid 1 extra payment every month? What if you just paid cash? Or what if you maybe didn't do this strategy at all? Something to consider, but maybe he ties all of it out in the last 60 seconds of this video.
Of your 30-year loan. Now, if your ambition, you got good money coming in, you decide to pay one every single month. Every month you write one check, and then you got another check towards principal only. Every month, you're gonna save about $276,000 worth of interest, and you gotta shave off about 21 year of your 30 year. Now that's a tip for you guys, that when you wanna make extra payment, you can think about that, and that's how you pay down your property faster. All right, you guys.
Just a tip, if you just pay thousands of dollars more every single month, you'll pay it off sooner. Wait a minute. I think I got it.
Now that is a wrap. I hope you all like what we showed you guys today and how you can actually buy 10 rental property here in the next 5 years by using this Burr strategy. This is the strategy someone taught me how to do, and I'm still implementing it today, and I'm teaching a lot of how to do it all across America, okay? If you have any questions or comment, please comment in below.
Love my guy Thatch. Parts of this video were so good. He has some real genius in here. This doesn't have anything to do with Burr. He didn't even talk about it at all, and so I don't know who he's teaching to do Burr, because number one, you shouldn't teach anyone to do Burr because it's stupid. BRRRR stands for buy, rehab, rent, refinance, and repeat. And all of that just popularized by, you got to come up with a new way to create a name. Just because I call something exactapa doesn't make it a real thing, right? It's just a cash out refinance. What BRRRR is, you're buying the property, you're putting money into it, your construction budget, you're putting a tenant in there, and you've got a loan, and then you're going back and refinancing all the money you put down, and then taking that money and buying another property. It sounds like a really genius idea. Until about 5 years ago or 10 years ago, when the influencers made that cool, it was just called a cash out refinance. We called it a cash out refinance. I should have come up with a name like Kofara or something really cool. You guys can in the comments tell me, what name would you come up with, something really, really cool. But here's the challenge. When you pull the money out of the property, in large part, almost 95+% of the time, almost all the time, you're gonna see it eliminates all the cash flow. What makes properties cash flow is two things. The discount you're buying it at. What makes properties cash flow is two things. The discount you're buying it, so how deeply you're buying it, and the percentage of down payment. As an example, if a house is worth $230,000 and I could go work really hard to find a great deal where I could buy it for $200,000, right? So I'm buying it below market. And then if I put 30% down, so I'm putting $60,000 down, and I had a mortgage of $140,000, that property will cash flow at $400 to $500 a month after all expenses and the mortgage. Here's the problem. The minute I go take my $60,000 and have a mortgage at $200,000, number one, I have all the mortgage costs, title costs, and appraisal costs of refinancing. And number two, when I do that, likely all that $400 or $500 is the increase in payment. And so now I've taken a cash flowing asset and made it a non-cash flowing asset. If you're going to go out and buy rental properties, you're going to have to put money down. Think of that, you're investing your money. That's what creates the return. If you like this video, hit the subscribe button.